If you've been following the AI space over the last few years, you know the story. It's been dominated by massive capital expenditures, revolutionary chips, and this race to build the biggest digital infrastructure on the planet.
Right.
But what if that? What if the defining phase of the AI revolution is already over?
It's a really compelling idea, and it's pretty much the central subject of our deep dives today. We are tracking a fundamental market shift, a rotation that moves the focus and, frankly, the money
And the money.
from the infrastructure builders to the practical implementers. And the core thesis is that these technological revolutions, they almost always move in two distinct phases.
Okay.
Exactly. You start with the phase where everyone is scrambling to build the foundational tools, and then you shift to the phase where the real economic value is created by, using those tools.
I think the best analogy is the internet revolution back in the 90s.
Perfect analogy.
So the first wave was the infrastructure, right? You had Microsoft with the OS, Intel with the processors, Cisco with all the networking hardware. They built the digital backbone.
The plumbing.
The plumbing, exactly.
Right. But the the generational wealth creation of that second wave came from the implementers. The companies like Amazon, Google, eBay.
The ones who use the plumbing.
They use that plumbing to completely redefine everything: commerce, communication, how we access information.
And our mission today is to recognize that we are right in the middle of that exact same transition in AI. The picks and shovels have been bought, they've been sold, and now the focus shifts
To the gold rush.
to the gold rush of practical deployment. This is all about identifying who is generating measurable profits by applying AI, not just building the computers to run it.
We're moving beyond the enablers and focusing squarely on the implementers.
So let's begin where all the investment has been. I mean, for the last 3 years, hundreds of billions of dollars have just been poured into building that digital foundation.
The chips, the data centers, the energy.
All of it.
And that foundation was absolutely essential to get us here. And it's easy to list the undisputed winners of this first wave. On the compute side, you had Nvidia and AMD
The GPUs.
providing the high-end GPUs for training, for inference. And to feed those hungry GPUs, you needed Micron technology supplying high-bandwidth memory, HBM.
Which is critical, right? Because the bottleneck isn't always speed.
It's often not. It's moving enormous amounts of data quickly to the processor.
And it wasn't just the silicon. The physical layer of the data center became this huge investment area, too.
Precisely. You have to cool all that heat, manage all that traffic.
Yeah.
So companies like Vertiv, they became indispensable for power and cooling infrastructure. Arista Networks handled the intense networking demands. And then, when the big cloud providers couldn't keep up, we saw the rise of specialized neocloud services like Nebius Group and CoreWeave.
Offering those highly concentrated GPU clusters.
They're just for very specialized AI workloads,
And powering all of this, which takes a staggering amount of energy-benefited power producers like Constellation Energy Group and Vistra. These companies really define that first capital-intensive phase.
But here is the report's central argument for rotation. It's that the market has already priced in years of this aggressive, massive data center construction.
Right.
The focus is rapidly shifting from just brute force expansion to efficiency. And if you look at the economics, these foundational holdings might soon face some headwinds as capital expenditure or CapEx.
A cost of buying and building the physical gear?
Right, as that begins to normalize.
I get the normalization argument, but I think we need to add a layer of complexity here for you.
Yeah.
Is the demand really cooling off, or is the infrastructure market just getting structurally more competitive?
That's the critical question. The first headwind is efficiency, yes. But the structural competitive threat is, I think, even more important. The largest customers of these chip builders, the hyperscalers.
Amazon, Google, Microsoft.
All of them. They are now designing and building their own custom silicon, their own ASICs.
And that's a huge problem for the whole Nvidia and AMD thesis. If your biggest, most essential customers decide they can build their own high-performance alternatives,
To control cost and customize performance.
they essentially become your direct competitor.
It introduces this significant competitive risk. It forces down the average selling price of specialized hardware. This is a structural threat that goes beyond mere normalization.
So leadership might rotate away from these foundational companies no matter what the overall AI demand looks like.
That's the argument.
And yet we have to acknowledge the counter perspective, which is a powerful one. What happens if the next generation of models, GPT-5 or, early AGI prototypes, what if they require not twice, but 10 or even 100 times the current compute power? Some experts are predicting that.
Right, and if that happens, you don't have moderation. You have an even more intense infrastructure arms race.
Right.
That kind of demand would completely contradict the cooling off thesis. However, even in that high demand scenario, the market is undeniably seeking new value creation. The high-hanging fruit, the profits built on top of the infrastructure, is now becoming the focus. The next leg of innovation is shifting to the implementers.
This is where the story gets really fascinating. The second wave companies aren't building the railroads, they're running the high-speed trains on them.
That's a good way to put it.
They apply AI directly to core business processes. They enhance productivity, increase margins, and just transform the customer experience. They are translating theoretical compute power into, measurable, tangible dollars.
So let's look at three very distinct approaches that are cited in the report. We can start with AppLovin, ticker APP, which represents the ultimate AI-powered profit engine, really, in the ad tech space.
Okay, so AppLovin runs a massive mobile advertising platform. It's an incredibly complex business, but their secret weapon is this proprietary engine, the AXON engine.
Right.
It's a deep learning system that optimizes mobile ad placement and pricing in real time.
And the mechanism here is what's key. Ad spend allocation used to be a lot of human intervention. It was a mix of strategy, guesswork, manual bidding.
An art form, almost.
An art form, yeah. AXON takes that art and transforms it into predictable profit science.
Yeah.
It trains itself on billions of daily ad impressions.
Billions.
And it instantly reallocates budget where the return on investment is highest, which eliminates human error and latency.
And the results are stark, which is why the market is paying attention. This has fueled a huge expansion in their profitability. We're talking sharp increases in both gross margins and EBITDA margins.
Right, and analysts are predicting earnings to climb nearly 60% next year on 37% revenue growth.
That divergence, earnings growing far faster than revenue, that is the pure definition of AI-driven operating leverage.
The key is scalability. AXON manages exponentially higher ad volumes without needing a comparable increase in, human analyst or fixed costs.
Yeah.
It scales revenue far faster than cost.
Okay, but we have to talk about the hidden risk. AXON's fuel is its data, billions of user profiles and behavioral signals.
And that data is under siege globally. In an era of tightening privacy regulations, think Europe's GDPR or the patchwork of U.S. state laws that are evolving.
Right.
Restrictions on how data is acquired and used for targeting could potentially affect AXON's performance, its targeting accuracy.
It's a major unaddressed risk. It all relies on the company's ability to navigate all those regulatory shifts.
That's right. Now, let's pivot to a completely different sector, healthcare. With Natera, ticker NTRA, if AppLovin's edge is optimization, Natera is their bioinformatics moat.
So Natera is a global leader in genetic testing. They analyze cell-free DNA or cfDNA.
Right. cfDNA is the tiny genetic material that's floating in your blood shed by tumors or a fetus.
And their challenge is finding these incredibly faint genetic signals using advanced AI with just unmatched accuracy.
Imagine looking for a single specific grain of white sand on a vast beach covered in billions of different colored grains of sand. That's essentially what they're doing.
And their competitive advantage, it comes from this proprietary AI foundation model they launched.
And that model is the ammunition. It was trained on one of the largest multimodal oncology data sets in the world. Over 250,000 tumor exomes, 1 million plasma time points.
All linked directly with clinical outcomes.
That's the key. This data advantage powers tools like a digital patient simulator, real-time clinical trial matching, and something called NeoPredict, which forecasts how a patient will respond to immunotherapy.
So they aren't just a diagnostics company anymore.
Not at all. They become a full-spectrum, AI-driven healthcare enterprise.
Now for the reality check, because this is crucial for you to understand. Natera is still unprofitable, yet it trades at this premium valuation.
Right.
And that valuation, it reflects the market's expectation of a near monopoly created by that massive specialized data moat.
And that expectation carries risk. Commercialization in the medical field is a long, arduous path. Every new AI-powered diagnostic tool, it requires rigorous validation, extensive clinical trials, regulatory approval.
And any significant delay in that process
directly challenges that highly priced valuation.
Yeah.
It makes it a very high-risk, high-reward proposition.
Okay, so our final case study highlights the importance of an asset-light strategy. Apple, ticker AAPL. They made a very deliberate choice here. They decided not to chase the hyperscale infrastructure race.
They did. They decided against that heavy CapEx drag. Their strategy is all about distribution and integration. Instead of building massive data centers, Apple focuses on embedding powerful on-device AI capabilities.
So personalized features, usability improvements, stuff that happens right on the iPhone or the watch.
Exactly. And they are leveraging their massive installed base. We're talking over 1 billion active devices globally.
1 billion.
They are positioning themselves to monetize AI usage through partnerships, similar to how they collect, an estimated $20 billion a year from Alphabet.
Just to keep Google as the default search on Safari.
It's the same playbook. Apple is essentially establishing itself as the primary distribution platform for AI-native mobile apps and services. They benefit from the AI era's activity without having to bear the significant cost of building or upgrading the underlying infrastructure.
So they get to reap the rewards of the second wave while the first wave builders are still dealing with the CapEx bills.
Precisely.
So we've looked at 3 successful examples: Apple optimizing profits, Natter leveraging unique data, and Apple using its ecosystem dominance.
Right. But now, to capture the next leg of this AI market rally, you need a reproducible method, a framework, really, to identify the next wave of successful implementers beyond just these specific names.
That's the real value we can provide here. We're moving beyond just giving the answer and trying to teach the method. We can synthesize the success of these companies into a 3-part checklist.
A checklist for evaluating any potential AI implementer you might encounter.
Okay, let's define the 3 pillars of this framework. Pillar 1, AI-driven margin expansion. I like to call this the profit center test. We aren't just looking for revenue growth. We are asking, does the AI directly and measurably increase gross or operating margins? It has to be a profit center, not just a flashy cost center.
To put it simply, we're talking about the percentage of every dollar that turns into profit. If a company is growing revenue by 50%, but their costs are growing by 49%, that's not AI leverage.
Not really.
But if their AI allows revenue to grow 50% while costs only grow 10%, that's explosive profit expansion.
And that goes right back to the AppLovin example. Their ACAXon engine turning ad deployment into predictable profit science is the measurable proof here.
Exactly. If the AI can't show up on the margin line, you should be skeptical.
Okay, pillar 2, defensible data moat. This is the ammunition test. Does the company possess vast, unique, proprietary, and critically difficult to replicate data sets?
AI models are only as good as the fuel they consume. The lesson from Natera is crystal clear. Their accumulated genetic and oncology data creates a formidable competitive barrier. If a company is training its algorithms primarily on publicly available data, the general internet, then its competitive advantage will rapidly erode because every single competitor can access that same fuel.
The moat has to be built from unique proprietary data.
It has to be.
And that brings us to pillar 3, asset-light ecosystem leverage. We can call this the scale test. Can the company deploy its AI solutions across a massive existing user base or network at extremely low marginal cost?
This is the Apple model writ large.
Right.
Can they scale without incurring that massive CapEx drag? The ability to push new, valuable AI functionality to billions of active users or network nodes without having to invest heavily in new physical infrastructure.
It means the marginal cost of deployment approaches 0.
It approaches 0. They effectively collect a toll on the AI era road, leveraging an ecosystem that's already there. This asset-light approach provides tremendous operating leverage that, frankly, outstrips the infrastructure builders.
So as we wrap up this deep dive, the key takeaway is that the AI market rotation, it's driven by clear, rational economic logic.
CapEx normalization, high infrastructure valuations,
And the new ability of firms to translate AI into tangible, measurable economics.
and the framework of profit, data, and leverage is your indispensable guide to navigating this next phase. Investors who are strategically positioned in both the foundational enablers, because look, that demand isn't going away.
Not at all.
And these high-performing implementers will be best placed to capture the full scope of the rally.
That brings us to our final thought for you to explore on your own. While the infrastructure giants like Nvidia face a high-stakes, competitive environment with high valuations and intense internal competition from their biggest cloud customers.
The true, enduring long-term value may be found not in the creation of the next generation of chips, but in the company that figures out how to make the current generation of chips run 10 times more efficiently for specific high-margin business applications.
So the efficiency race.
The efficiency race, the operational leverage gained through implementation, that might be the ultimate and most profitable test of this second wave.